What if you didn't have to pay taxes after you sold property? Well, that's exactly what you can end up doing with the 1031 exchange that I'm going to explain right now. Welcome to Jerome in Real Estate. I'm Jerome, your local realtor here in the Fountain and Colorado Springs area. Today we're going to be talking about what's known as the 1031 exchange. So, usually capital gains happens if you sell an investment property, right? You got to pay capital gains tax. That varies depending on your overall income, but usually there's just no escaping that. If it's an investment property and then you end up selling it, you've got to pay capital gains tax at the end of that. What I'm about to talk to you right now about is what's known as the 1031 exchange. So let's get into it. The 1031 exchange is named after basically Section 1031 of the IRS tax code. Okay. Basically what that is, it is swapping out one investment property for another. Okay. And it is a way of delaying, not completely getting rid of. It is a way of delaying or deferring your capital gains tax on that particular transaction. But like I'll explain later, the ticket is you can just keep doing it over and over again. So what is technically supposed to be a deferral ends up being forever if you're the right type of investor. It is something that is termed as having to buy a like-kind property by using the proceeds of a sale of another property. Okay, so let's go ahead and break down some of the rules. This is going to be a quick video, so I'm going to roll down the rules, very quickly, just real down and dirty here. So rule number one, there's no limit on how many times you can do a 1031 exchange, right? As I stated before, rule number two, the properties must be like kind. And it's important that you understand that like kind is really in the mind of the IRS. And luckily for us, it is very broadly defined. It can be, a single family residence. It could be a duplex. You could switch out a duplex for a fourplex. You could even go land for real property. So it's a very broad concept of what like kind actually is. This is where you probably want an advisor beforehand to go through exactly what the IRS is talking about here, but it is a pretty wide scope of what like kind is supposed to mean. It applies to investment property and business, right? So you can swap these things out, like kind, right? So an investment property for an investment property. I believe you can even go business to investment property or investment property to business. I'm not 100% certain on that. I'll check into it. Now, you can't personally hold the proceeds of that initial sale. Let's say you sell a property and you're trying to exchange it for something else, right? You're trying to do this 1031 exchange. You cannot sell one property, hold the proceeds yourself, and then try to identify and buy the next property. Okay? You're going to need to have an intermediary. So you sell the property, all the proceeds never touch your hands. They go to the intermediary. You identify the next property that you want to exchange it for, and then the intermediary is the one who is putting in the proceeds from the last one into the purchase of the new one. If it touches your hands, then you're immediately going to be responsible for capital gains tax. That's how this works. All right. You can do a reverse exchange. So the process I just described is the straightforward one, right? You sell the property you have first, then you find the new subject property and you buy that one based on the proceeds of the last one. You can do it in reverse order. You can buy first and then sell the one you have, right? and all the timelines will just have to match up. And I'll explain what the timelines are in a second. The next rule, the final rule that I'll go over, is that what we call the boot will be taxed. Okay, now the boot is basically the difference between the sale property and the buy property. Let's say your initial property you're selling for $500,000, right? And then the one that you found to exchange it with is only going to end up costing you $450,000. That $50,000 difference is what we're terming as the boot. And since that's not going into the new property, you're just getting it, you're going to be taxed on that $50,000. All right. That's just, simple numbers. I only did that just for simple math. Okay. But that's what's going to happen. Now, timelines for the 1031 exchange. So from the time you sell your initial property, okay, you have 45 days from the close of that sale to identify a replacement property. Now, the rules do state that you can designate 3 replacement properties. It's just that one of them you have to move forward with. The next rule within timelines is that you need to close on that selected property within 180 days of that initial sale, right? So you sold one property, you got the closing date. Within 180 days of that closing date, the new property must get closed on as well, right? So that's actually not that bad. It's a decent amount of time. For small time investors like us, us small time guys. Once again, I did note that you can do a reverse exchange. So the timelines are the exact same. You still only get 45 days to identify, and then 180 days between the closings, right? So that's the down and dirty of a 1031 exchange. And it basically does allow you to defer your capital gains tax when you're selling investment property. But now you need to think big, and you need to say to yourself, okay, one of the rules was that there is no limit to how many times I can do this, right? So you could 1031 exchange property after property after property. And like I said, a like kind exchange has a very broad, it's painted with a very broad brush, all right? So you could actually be moving up in value of property little by little, right? And by the time you're old and gray, you could have a property worth millions that you never paid any capital gains tax on the entire time, because you've just been exchanging and moving up in property size and in value the entire time, and you didn't have to pay any capital gains tax. All right. So if you have any questions about this or anything about real estate, please reach out to me. And if you like this type of content that I'm putting out, give me a like, give me a subscribe, and I'll see you at my website, jeromeandrealestate.com.